Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Thursday, March 9th, 2023. What's up with California? That's a big question. We'll try to dabble into two sides of it. Two interesting data points. This morning, we got information on continuing and initial jobless claims. These are weekly numbers that we receive from the Department of Labor, and we actually can see in the state data. We had a minor jump, I'm going to say it's meaningful, in claims, moving up roughly 110 in the seasonally adjusted number and a little bit more in the non-seasonally adjusted number. We're now running roughly 240,000 claims per week, non-seasonally adjusted, and a little bit over 200,000. Clearly, very low numbers historically, but we did see a 25% movement in the initial jobless claims of California. And we do see that volatile. It comes in usually around 20%, and California's population is around 12%. So it's disproportional. It may have, in terms of reporting process, claims, could be a benefit issue, could be immigration issues, are all an important element to those numbers. So we want to be sensitive. And yes, we see states like Pennsylvania and even New York a little disproportionate. So it's not just California that has that issue. In addition, if we look at the numbers from the New York Fed, this came out last month, and it talked about the consumer credit environment. Here, we actually got state data on leading states, and we see the average indebtedness per capita of the Californians rough above 80,000. And the next states are actually all piled together in the 40,000 to 60,000 range. So we see a disproportionate amount of debt per capita to California. Cost of living is high. Clearly, there are other elements like gasoline, regulation that do have an impact in the California economy, but it's actually quite meaningful. Yes, a major export from the state of California is aircraft. We've talked a lot about the non-defense aircraft category and how important to the US export market that is. So yes, it's an important economy to the country. However, it seems to be sagging a little bit in comparison to other parts of the country. And we could actually really drill down and say, especially to the Southeast, we've seen the house values in the West Coast depreciate faster. Clearly, they come from a higher level. At the same time, the Southeast continues to be producing jobs and stable housing values and growth. So these are the characteristics we want to be aware of. Yes, we are looking for broader trends in the US economy and how they impact. But when we look at these regional numbers, we do get a bifurcated story, and that's worthy to note as we move ahead. So we are expecting a recession coming in end of this year, early next year. We still think a little bit mild on it. However, California may actually be much worse, and it may move itself into a recession or a more severe recession than the rest of the country. And that may actually cascade into other parts of the US economy. It's worth keeping our eyes on. It's worth keeping impact on it. But in general, the employment market, other than California, seems to be solid. The California employment market is still healthy. So we want to keep our eyes on the different elements between the different different parts of the country as we move forward. It may tell a different story, and it may give us some insights into the duration and the timing of the downturn. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.